Hello and welcome to an FXTimes daily market recap. I'm your fundamental market analyst, Nick Nassad. Today is Wednesday, March 24th, 2010. We start today's broadcast with a look at the euro-dollar pair, which fell rather sharply in today's trading, hitting a fresh 10-month low against the US dollar as we had continued issues of sovereign debt in Greece as well as a downgrade to Portugal, which caused a lot of risk aversion and safe haven flows towards the dollar. We entered this week breaking below the 1.3550 level, and then we retested it as resistance in yesterday's session, and that was our high for the day. But in today's trading, we fell below our more important support, which is 134.50, which had been the bottom of a consolidation in the euro dollar that goes back about 2 months. We have been stuck between 1.3450 and 1.38, and we finally broke out of that range. What we saw today was news that the International Monetary Fund could now lead a rescue package for debt-strapped Greece, according to reports after Eurozone leaders had insisted that the solution to Greece's debt problems would be handled within the Eurozone. A meeting between the European Union leaders on Thursday and Friday won't bring about any decision on aid for Greece, and any support for that country would only be a last resort and would have to involve a substantial contribution from the IMF, according to German government officials. That official says that using the IMF as the main proponent of the rescue package has seen increased support within Eurozone countries. Also adding to the woes of the euro was that Fitch Ratings downgraded Portugal's credit by 1 notch and issued a negative outlook for the Eurozone nation. So traders are turning their attention to some of the other periphery countries on the Eurozone, and overall it has been very euro negative. The slide in the euro came despite some better than expected fundamental data, including a surge in the Purchasing Managers Index reported overnight. The flash manufacturing PMI for March rose to 56.3, while the services PMI rose to 53.7. Those readings showed that those sectors grew by the fastest rate since June of 2006 and November 2007 respectively. Manufacturing growth has outpaced that of services, so we'll see if that disparity continues going forward. Taking a look at one of our currencies that is very sensitive to risk appetite, the Australian dollar versus the US dollar, we see that we had a sharp slide from our resistance here around 0.92, and we have moved back down to test the bottom of this range we've seen the last 2 weeks with 0.91 as support, though we did slide a little bit below that in the New York session. So the theme of risk aversion is very prevalent in the markets, and it has boosted the strength of the US dollar, which according to the US dollar index reached a 10-month high. Now, in an interesting development, we did see the US dollar Japanese yen pair rise sharply in today's trading, breaking us out of this sideways range we have been monitoring the last 2 weeks. We had a strong push above the 91 level, and we tested resistance just below 92. We had some hawkish language come from the San Francisco Fed President Janet Yellen, as she said she's ready to raise interest rates when the time has come. Yellen has been one of the more dovish members of the FOMC, and the markets reacted by showing a big slide in US bond prices, which helped to raise yields. Now, the yen usually does gain when there is risk aversion in the markets, but that was not the case in today's trading. So there may be some big players pushing the market around, and we broke through any sell orders around the 91 level. For instance, if we take a look at the Australian dollar against the Japanese yen, we see that the Australian dollar gained in today's trading, even though we had, for the most part, risk aversion in the markets. So this was an interesting development and a serious sign of yen weakness. We'll see if it continues throughout the rest of the week. The US dollar Canadian dollar, meanwhile, retested its resistance level in today's New York trading around 1.0240, which had acted as support earlier in March, but we pushed above that level, and now we move back into these levels that had been a consolidation zone, and so we can see our next resistance level as the highs that we had here around 1.0320. The pound-dollar pair, meanwhile, tested its support around 1.4875, which extended the decline we had seen to end last week's trading. The UK released its budget for the next year, and the Chancellor of the Exchequer, Alistair Darling, said that the task ahead is to lower borrowing without damaging a nascent recovery. Now, while the government will stick by its plan to have the budget deficit over the next 4 years, he again said that there will be no spending cuts this year, which is different than what the opposition Conservative Party has proposed. Again, there are elections coming up in that country, so who wins will determine the government's policy. If there is a hung parliament, however, it'll be hard to push through spending cuts, and that has been weighing on the pound in the last month or so. From a technical picture, it does look that the rally we had seen between March 10th and March 18th in the pair, which reached the 1.54 level, has now petered out, and now we're actually testing that old low. So that is a roundup of our major currency pairs. So let's take a look at some fundamental US data we had come out today. U.S. durable goods orders for the month of February rose 0.6%, which was closely in line with expectations, while we did have a pretty large upward revision to January's figure. Originally, it had posted a 2.6% increase, but now it has been revised up to show 3.9%. So while today's headline figure was slightly smaller than forecast, overall, I think traders see that it met expectations. It's the third month in a row of durable goods orders gains, and as we can see from the chart to the right, the yearly change is now running at around 10%. U.S. new home sales for the month of February fell by 2.2% on the month to an annualized rate of 308,000. That is a fresh record low, as we had January's reading revised upward to show 315,000. Previously, January's reading was our all-time low. Supply swelled to 9.2 months, which is in line with a similar reading we had on the existing home sales side in yesterday's session. We'll see if January and February will prove to be the lows for the housing sector, as mortgage applications for home purchases have firmed in 3 of the last 4 weeks, and we are going to be approaching the second expiration of a homebuyer tax credit in the coming months. The two reports didn't provide U.S. equities with any boost, and for the most part were lackluster. So the U.S. stocks were down because of general risk aversion in global markets following the Portuguese downgrade, which again has added to the strength of the U.S. dollar. Taking a look at the fundamental docket for the upcoming session, tonight we are going to have the GDP figures for New Zealand for the fourth quarter, which is expected to show the economy increasing 0.8% for that period. We will also have a measure of Japanese inflation, the corporate service price index. Overnight, we get consumer confidence data from Germany, as well as money supply figures from the Eurozone and retail sales from the UK. The docket is rather light in tomorrow's New York session, as the main release will be the weekly jobless claims data. However, we do have testimony from Fed Chairman Bernanke at 10 a.m. and the Q&A could be sure to move markets if there's any new language provided by him in terms of monetary policy. So that will wrap up today's coverage of the Forex markets. For more news, videos, and analysis, please visit our site FXTimes.com. I want to thank you for watching and wish you good trading.